In this video, we're going to go through 7 key candlestick patterns, starting simple, then building into more advanced setups. But more importantly than just recognizing patterns, you're going to learn how to combine them with price action so you can actually spot high probability trades. Because here's the reality. A lot of traders can point at a chart and say, that's a pattern, but they still lose money. Why? Because they don't understand what the candle is actually telling them. So let's slow things down and start from the foundation. Candlesticks are just a way to visualize price movement over time. Each candle represents what happened during a specific period. On a 1-hour chart, that's 1 hour. On a daily chart, that's 1 full day. Nothing complicated. What matters is what happened inside that candle. There are 2 main types of candles: bullish candles and bearish candles. If a candle closes above where it opened, it's bullish. That means buyers had the upper hand. If it closes below where it opened, it's bearish. That means sellers were in control. Simple concept. But this is exactly where most traders stop learning. And that's the mistake, because the real insight isn't just in the direction. It's in the behavior of the candle itself. Every candlestick is made up of 2 parts, the body and the wicks. The wicks show you the extremes, the highest point price reached and the lowest point price dropped to. The body shows you the open and the close. For bullish candles, price opens at the bottom of the body and closes at the top. For bearish candles, it opens at the top and closes at the bottom. But instead of just memorizing that, think about what it represents. It's a visual record of a fight between buyers and sellers. Now, before we get into patterns, there are 2 important ideas you need to understand first. This is where charts start to make sense. First, the size of the body shows who's in control. Let's say you're looking at 2 bullish candles. They both closed higher, but they're not equal. One has a large body with barely any wicks. That tells you buyers dominated almost the entire move. Sellers tried to step in, but they didn't stand a chance. Price moved up cleanly and closed near the high. That's strength. Now look at a candle with a small body and long wicks. That's a completely different situation. Price opened here, then buyers pushed price up. And as it got pushed up, sellers stepped in, aggressively pushing price back down, closing just above the open. In this candle, we can see that the buyers were still stronger than the sellers, although the sellers were able to push price down close to the open. Second, wicks reveal rejection. This is where things get interesting. A long wick at the top of a candle means price tried to move higher, but got rejected. Sellers stepped in and pushed it back down. That level didn't hold. On the other hand, a long wick at the bottom shows rejection from lower prices. Sellers pushed price down, but buyers came in strong and reversed it. That's a key signal of demand. These rejections often highlight areas where price is likely to react again. If you're getting value from this so far, make sure you hit like and subscribe so you don't miss what's coming next. Now let's get into some of the most important candlestick patterns, starting with the basics. Pattern number 1, the bullish pin bar. This is one of the clearest signs that price might be getting ready to reverse to the upside. At a glance, it's easy to recognize. You're looking for a candle with a small body, a long wick below, and little to no wick on top. But instead of just memorizing the shape, let's break down what's actually happening. Price opens, and almost immediately, sellers step in and push it down. For a moment, it looks like they're in control, but then something shifts. Buyers enter the market aggressively, and not only stop the drop, they push price all the way back up, sometimes even above the opening level. That rejection from the lows is the key. It tells you that sellers tried and failed, and buyers took over. Now, when you see this happen after a strong move down, especially at a key level, it can be a sign that momentum is starting to shift. That's where this pattern becomes powerful. Pattern number 2, the bearish pin bar. This is essentially the mirror image of the bullish version. Same idea, just flipped. Here, you'll see a small body, a long wick above, and little to no wick below. Now let's walk through the story. Price opens, and buyers step in with confidence. They push price higher, creating that long wick at the top. But then, sellers step in. And they don't just slow things down, they take control. They drive price back down, often below the opening level, and the candle closes near the lows. That upper wick? That's rejection. It shows that higher prices were not accepted. So when this forms after a strong upward move, especially near resistance, it can signal that buyers are losing strength and sellers may be taking over. Pattern number 3, the doji. The doji is a unique candlestick because unlike most patterns, it doesn't tell you which direction the market is likely to go. A doji forms when the opening and closing price are nearly the same, creating a very small body. At the same time, you'll usually notice wicks on both sides, often similar in size. Now think about what that means. Price moved up, price moved down, but in the end, it finished almost exactly where it started. That's a clear sign that neither buyers nor sellers were able to take control. It's a standoff. Now on its own, a single doji doesn't give you a trade signal. It simply shows that the market is pausing. But when you start seeing multiple dojis forming close together, that's when things get interesting. Because now you're looking at a buildup. Buyers and sellers are both fighting for control. And eventually, one side is going to win. When that happens, price often breaks out with strong momentum. So instead of ignoring dojis, use them as a warning that a bigger move could be coming next. Up to this point, all the patterns we've covered involve just one candle. Now we're going to step things up and look at patterns that involve 2 candles working together. Pattern number 4, the bullish engulfing. This is a strong signal that momentum could be shifting to the upside. It's a 2-candle pattern. First, you'll see a bearish candle. Then immediately after, a larger bullish candle that completely covers or engulfs the previous one. Not just the body, but ideally the entire range. So what's the story here? At first, sellers are in control. That's your first candle. But as the next candle begins, buyers step in aggressively. They don't just slow the market down. They completely overpower the sellers. Price pushes up, breaks past the previous high, and closes strong. That shift in momentum is what makes this pattern powerful. It shows that buyers didn't just enter the market, they took over. And when this appears after a downward move, especially at a key level, it can signal that price is ready to move higher. Pattern number 5, the bearish engulfing. This is the opposite scenario. Same concept, just reversed. You start with a bullish candle, showing buyers in control. But then the next candle opens, and sellers step in with force. They drive price down so aggressively that the new candle completely engulfs the previous one. It breaks below the prior low and closes strong to the downside. That tells you everything you need to know. Sellers didn't just react, they dominated. They erased the previous move and pushed price even further. So when this pattern forms after an upward move, especially near resistance, it can be a sign that the market is about to turn lower. Now let's move into the advanced patterns. These are more powerful because instead of just 1 or 2 candles, they tell a full story across 3 candles. Pattern number 6, the morning star. This is a 3-candle formation that signals a potential reversal to the upside. Let's break it down step by step. The first candle is a strong bearish candle with a solid body. This shows clear selling pressure. Sellers are in control, pushing price down with confidence. Then comes the second candle. This one is small, usually a doji or a pin bar with long wicks. It can be either bullish or bearish. The color doesn't really matter here. What matters is the size, because this candle represents a slowdown. The strong momentum from the sellers is starting to fade, and the market is beginning to hesitate. Now comes the third candle, the most important part of the pattern. This is a strong bullish candle that pushes upward and breaks above the high of the middle candle. That move is key because it confirms that buyers have stepped in with strength. Now here's how you judge the quality of the setup. If this bullish candle is large, similar in size to the first bearish candle, that's a strong sign. If it's small, the setup is weaker. And if price pushes all the way up and closes above the high of the first candle, that's even stronger confirmation of a reversal. Now let's look at the story behind it. At first, sellers are fully in control. They drive price down aggressively. Then suddenly, momentum slows, the market pauses. Buyers start stepping in quietly while sellers begin to lose strength. And then, buyers take over. They push price up with force, shifting control completely. That transition from strong selling to strong buying is what makes the morning star so powerful. Pattern number 7, the evening star. This is simply the opposite of the morning star. Same structure, flip direction. The first candle is a strong bullish candle. Buyers are in control, pushing price higher. Then comes the second candle, a small-bodied doji or indecisive candle. This shows that buying momentum is starting to weaken. Sellers are beginning to step in, but neither side has full control yet. Then comes the third candle, a strong bearish candle that drives price downward. This candle confirms that sellers have taken over. Now think about the psychology. Buyers start strong and push price up. Then the market slows down. Hesitation kicks in. There's a battle between buyers and sellers. And finally, sellers win. They push price down and shift the momentum. So these were the 7 candlestick patterns that can help you spot trade opportunities. But we are not done yet. We will now understand how to use price action concepts to find entries using these patterns. We will use order blocks and fair value gaps to combine the candlestick patterns with price action. Now let's walk through a real example. Looking at the chart, we can see that price pushes above previous highs. This movement creates a clear break of structure to the upside. And once structure is broken in this way, our overall bias becomes bullish. Now, what does that mean? It means we are only interested in buying opportunities. No sells, buys only. After the break of structure, price leaves behind a valid fair value gap. This is important because fair value gaps often act as areas where price is likely to return before continuing in the direction of the trend. So now, we patiently wait for price to retrace back into that zone. As price returns to the fair value gap, we start to look for confirmation. First, we notice a medium-sized bearish candle forming within the zone. This shows that price is pulling back, which is expected. But then something interesting happens. Right after that bearish candle, we see a bearish pin bar form. This is a key signal. The bearish pin bar tells us that selling momentum is starting to slow down, and the market is becoming indecisive. And then, the confirmation we've been waiting for. A strong, bullish engulfing candle forms immediately after the pin bar. This candle shows that buyers have stepped back into the market with strength, taking control from the sellers. This is our entry signal. We enter the trade at the close or just after the formation of the bullish engulfing candle. For our target, we aim for a 1 to 2 risk to reward, aligning with the overall bullish structure. And for risk management, we place our stop loss just below the lowest point of the retracement, protecting ourselves in case the setup fails. Now let's take a look at the next example. Here, we can clearly see that price is in an overall downtrend. As price moves lower, it leaves behind multiple valid fair value gaps and order blocks, some of which price has already reacted from. Now, this is important, and not every zone will give us an entry. So as traders, we have to stay patient and wait for confirmation. Moving forward, we see price push up into an order block. But when it reaches this zone, there's no strong reaction, no clear confirmation. So what do? We do nothing. We let price continue to play out. Price then moves higher into a fair value gap. And once again, no valid reaction. Still no entry. This is where most traders go wrong. They try to force trades in every zone, but we wait. Finally, price reaches another order block. And this time, we start to see something different. A bearish doji forms. Now this is key. That doji is telling us that buying momentum is slowing down. The market is becoming indecisive right at a key level, but we're still not entering yet. We wait for confirmation. Then the next candle forms, a strong bearish engulfing candle. And this is exactly what we want to see. This candle not only engulfs the previous doji, but also breaks below the prior bearish candle. This shows that sellers have stepped in with strength and are now in control of the market. This is our confirmation. We enter the trade at the close of the bearish engulfing candle. For our stop loss, we place it just above the high of the retracement, right above the doji, giving the trade enough room to breathe while still protecting our risk. And for our take profit, we target a 1-to-2 risk to reward ratio, aligning with the overall bearish trend. Now let's move on to another example, this time focusing on a bullish engulfing pattern. Looking at the chart, we can see that price makes a strong move to the upside. And in doing so, it breaks above the previous high. This break of structure tells us one thing clearly. Buyers are now in control of the market. Now during this move, price leaves behind two key things, a fair value gap and a bullish order block. This is powerful because now we have multiple areas of interest where price is likely to return before continuing higher. So again, we wait patiently. As price retraces, it comes back into this zone, tapping into both the fair value gap and the bullish order block at the same time. And this is where things get interesting. Once price enters the zone, we don't enter immediately. We wait for confirmation, then price prints a strong bullish engulfing candle right inside the zone. This is exactly what we want to see. That engulfing candle shows clear rejection of lower prices and confirms that buyers are stepping back into the market with strength. So now, let's break down the confluences behind this trade. First, the market structure is bullish. Price has already broken above the previous high. Second, we have an imbalance, also known as a fair value gap, created during that breakout. Third, price left behind a valid bullish order block within that same move. And fourth, when price returned to this zone, we got confirmation in the form of a bullish engulfing candle. That's 4 strong confluences lining up in one area. This is a high probability setup, so here's how we execute. We enter the trade at the close of the bullish engulfing candle. We place our stop loss just below the rejection point, the lowest point of the retracement. And for our take profit, we target a 1-to-2 risk to reward ratio, staying aligned with the bullish trend. Now you understand how to read candlesticks. But remember, patterns only work when used in the right areas. If you got value from this, hit like and subscribe so you don't miss what's next. And if you want to level this up, check out my previous video on order blocks. This is where everything really starts to come together. I'll see you in the next one.